today you've got billions of people who are very comfortable with what I would call microtransactions. They've got a credit card in multiple places on the internet, and they have no fear of spending $1 or $3 or $5 or $10 a month on something that's a new product that they're going to try. That wasn't happening 15 years ago. And so the one counterbalance to the trough of disillusion, revenue is going to take a long time to play out. The counterbalance to that would be, imagine if there is something really compelling, and we've seen this with ChatGPT. If there's something that's really compelling that comes along from Apple or Meta or a startup, it'll take off quickly and it'll blow people away at how fast the revenue growth is. And we just haven't seen that yet. The entrepreneurs haven't even had a chance to get these companies off the ground yet, but they're coming.
Welcome to OK Computer. I am Dan Nathan, joined by Jeff Richards. He's the managing partner at Notable Capital. Jeff, welcome back to the pod.
Great to be here. Good to see you. You look good.
Man, it's as do you. It's been a while. I think we last talked in April, and you gave me a little bit of the rundown of what you were seeing in the private markets as it relates to generative AI, some of the valuations, just some of the trends that you were seeing. And then we obviously talked a bit about the public markets. To me, I think the public markets have been gaining a lot more of the headlines of late. Maybe there's a little open AI stuff, a little Anthropic and the like, but it seems like a lot of the rounds that we were hearing early this year, late last year, of just Google people or DeepMind or this, that, whatever, starting, these things and being minted at like unicorns right away. It seems like that's abated a little bit. So a couple other things I just want to hit here. I'll just set the stage really quickly. The Apple event, this Glow Time, just got done as you and I are set to record. I'd love to hear a little bit of some of the thoughts. I watched it. Pretty uninteresting to me, but I guess the real question is how they're going to integrate generative AI models onto the device and what that means for their services business. The other thing I got to hear, why is software so soft in the public markets here? I think that'll be something that you will be able to help us with. So, and again, just kind of lay of the land in the private markets. Where do you want to start here, man? Do you want to set the stage for what you're most focused on right now as a tech investor? I know one of the interesting things about you is that you have this kind of barbell approach. You're obviously very focused on investing in the private markets, but you have tremendous knowledge and you lean on what's going on in the public markets to help inform that.
Yeah, look, I think one of the big broad trends for the last few years has just been the dominance of the Mag 7. And I'm going to get to how that ties into the private market, but it's really just astonishing when you look at the 7 versus the other 493 and the way that we perceive the strength of the market over the last 2 or 3 years, really so driven by those companies. And if you own QQQ, you own SPY, you own any of these major ETFs or indexes, you own so much of Apple and NVIDIA and Microsoft and Google, which has obviously been good for everybody who does. But I think, one of the interesting things that also does is when you think about people who are allocating assets all over the world, there was a tremendous amount of interest in private markets from, call it 2012, 13 up till 2000, really till the COVID pandemic hit. Obviously the market cratered, then came roaring back. But I think so much of the dollar allocation right now is going to those 7 companies that, you talk to public hedge fund guys who used to do crossover investing in private markets. A lot of them were putting money into private companies, the top fastest growing private companies. And now so much of that capital is just being allocated to to NVIDIA or to Google or to Amazon. And I understand why. They're very safe bets. They've got a play on AI, which is obviously the future where technology is going. But at some point, these things tend to be cyclical. At some point, NVIDIA is going to miss, or, AMD is going to come out and guide soft, or Broadcom is going to guide soft, or something's going to happen. I don't know when. Morgan Stanley came out with a report, I think it was last week or 2 weeks ago, talking about how they're forecasting a slowdown, they think, in chip sales in 2025. When that happens, perhaps we'll see more of a rotation and an interest of allocating capital into the private markets. For now, what you've got is venture capital firms like ours that invest in early stage companies, seed, Series A and Series B, going out and trying to find the companies that are selling picks and shovels into that generative AI market. It's early. We're not seeing the revenue impact from generative AI. You asked about software show up in the small and mid cap software names yet. I think it will show up in 25 and 26. But there are a lot of picks and shovels companies being started by amazing founders right now. And it actually is a great time to start a business in that space. Cybersecurity, cloud infrastructure, anything that's tied to the rise of this new wave and trend around AI is going to be probably attracting a lot of early stage capital. And then the market that's just been soft in the private market has been the growth stage. So anything valued between, call it 300 million and a billion, is just sort of no man's land. And really there's two reasons for that. One is the thing I mentioned earlier, which is the crossover capital that isn't really coming into the private markets. And the other is lack of exits. We've had a dearth of IPOs for almost 2 years now, and it's been hard to get M&A deals done with under the current FTC regime. So it hasn't been a super lucrative exit market, which then sort of constrains the flow of capital into those growth stage private companies.
Yeah, we'll definitely talk a little bit about regulation because I think that obviously there's a whole host of like anti-competitive stuff, but there's also a lot of pressure on the ability to kind of put companies together. And to your point, just the IPO market and where it is, it's just like a lot of the exits, the dual kind of process is out the window at the moment. And I've been saying this for a while. The NASDAQ was making basically new highs every day for the first few months of the year. And if you can't bring a tech IPO in that environment, when are you going to be able to do it? So let's go to this Mag 7 for a second. And I think that's really interesting what you're saying. Another thing actually about the exits is that, these crossover investors, as you mentioned, they've just become so big and they've distorted the market to some degree, right? So hedge funds that used to deal with long short equities, but they've been playing now for 10 years in these growth stages of these companies. So when you get to IPO, there's no incremental buyer because they used to be the incremental buyer on the deal. So maybe that's leaving that private for longer. They can keep the marks where they are, that sort of thing, and not have a public down round. That's just my 2 cents. But let's go to the Mag 7 here, because I think what you mentioned is really interesting. So the picks and shovels in the private markets and the public markets, because of passive investing, these 7 companies made up like $10 trillion in market cap at their highs a couple months ago. And when you think about that, what that is, it was 17% or so of the S&P 500. It was a greater percentage of the NASDAQ 100. If you looked at the MSCI World Index, it was like somewhere in the teens of that. So just think about that, right? And so when I think about what's going on over the last month or so, the S&P is down about 4% from its recent all-time highs. The equal weight S&P is only down 2%. You and I can talk a little bit about that. And the NASDAQ's down about 10%. But let's look at Microsoft, Google, Amazon, NVIDIA. We could all agree the 4 biggest beneficiaries of Gen AI over the last 2 years. Microsoft down 14% from its recent highs. It's up only 8% of the year. So it's underperforming the NASDAQ. That's pretty interesting. Google's down 23% from its recent all-time highs and was only up 7% of the year. Amazon down 13%, only up 15% of the year. And then NVIDIA, we're going to save this for a separate bucket. It's down 25% from its recent highs, but it's still up 115%. Let's talk about the hyperscalers first, how you're thinking about this, because easily the biggest beneficiaries outside of NVIDIA, they're also NVIDIA's biggest customers, right? When I think about NVIDIA's earnings last week, and you just mentioned this, when we're going to start to see guides, well, they kind of guided gross margins down. And then what Broadcom had to say, it kind of did not leave a lot of room for error as it relates to, on a sequential basis, what they're doing, but also they have really tough compares year over year too, right? So let's talk first about the hyperscalers, and then I'd love to hear what you think in the semi space.
Well, it is amazing how intertwined these companies are, right? You mentioned the one company you didn't mention was Meta, by the way, which I think is going to have a very interesting play in the Gen AI space or AI space. But the other thing that's really interesting is they're all developing their own technology. So Google, Apple, Microsoft to some extent, we don't really know from the outside, but the rumor is that they're all trying to work on their own version of next generation chips and the things that they need to support their own infrastructure. And yet these companies are all intertwined. So Microsoft is spending money with NVIDIA. NVIDIA needs Microsoft to keep going. They're building out ahead of the curve of demand. So you look at the revenue, we're not investors in OpenAI, but the rumor is ChatGPT is now doing well over $1 billion a year of revenue. It's really the first consumer oriented, or call it, prosumer oriented product that's been a real hit in this Gen AI phase. But there's a lot more coming. I mean, there is. I know. We're going to go through the very traditional hype cycle here, which is, technology launches, gets overhyped, then people get demoralized and say it was, was massively overhyped, and then it comes back and makes a huge impact on the world. This is what the internet did. It's what mobile did. It's what cloud did. That we are probably entering into the downward phase of that cycle. And in 25, people are going to be claiming that Gen AI is massively overhyped. I think one of the catalysts for turning around that view will be Apple. So I have not had a chance to do a deep dive on the event they hosted today, but I did see that they talked a lot about their next generation phones and how tied in they're going to be into using their consumer version of AI. Which, with a billion installed users all over the world, that will be the first thing that people sort of ubiquitously use and changes the way that they probably interface. Think about going to your phone and just saying, book me a dinner reservation, book me an airline flight, book me a trip. You won't be typing it or going through an app, which has all kinds of implications, by the way, for the app store model, the rev share model. So that's a
Well,
whole different
advertising too. But
and advertising.
yeah, Jeff, let me just interrupt for 1 second. So I did watch the event. It's interesting to me that they did not mention OpenAI once. They talked about how the device is going to be able to run different models to do different things. So the thing about Apple Intelligence, and this was my view when they launched it in June 10th at the WWDC, is that there's nothing there. It's built on Siri, which all of us have a very, very troubled relationship with over the last 10 years, right? So you don't have a lot of confidence right out of the gate. And this is not a really branded sort of thing with like this trusted partners, if you will. So they said that, yeah, there's going to be some on device stuff, but all of that and the trust that you're going to place in this sort of technology, this is like a year or two away, in my opinion, right? And so, a lot of folks, as it relates to Apple, are saying similar things to what you just said. It's going to be with a 1.5 billion installed base globally, with hundreds of millions of these iPhones that are 2, 3, 4 years old. This is going to cause a massive, upgrade super cycle. Maybe it will, maybe it won't. What I saw there is not anything that we think. I don't think you're going to be able to
Nothing blew you
use.
away.
Well, I don't think there's going to be anytime soon. So again, I agree with you. I think that Apple iPhones will be basically the gateway drug to using generative AI in a consumer fashion. But OpenAI is the one that I find really interesting because you said 1 billion for ChatGPT. I see these things, and I'd love to get your take on this, and I'll shut up. It's like I see them becoming very commoditized. I mean, once you're done training all these models and it's really just about inference, it's like, how are you engaging with this sort of technology on what devices, for what purposes? What are the charges associated with that sort of thing? And again, I think all this stuff is still, yet to be determined, which is why one of the things I just think is like the markets have pulled forward so much excitement. So if we're going to go into that, that trough of disillusionment, or we're, about to set, well, that makes some sense to me because the revenue is not there. So thoughts on all, I know there's a lot, but thoughts on all that.
Yeah, no, I do think that's where we are. I think you combine that with external factors like an election, you've got all this political unrest around the world. There's just a lot of stuff that is making people jittery, right? Is the US going to go into recession, or is the Fed going to lower rates? There's just a lot going on, which sort of causes people to want to pull back and take less risk. But I do think we'll go through the typical cycle, trough of disillusionment. I think it'll be next year. And then you'll start to see some of the, what we haven't seen at all is any of the, call it $5 to $20 billion small, mid cap software companies take up their guide based on any type of new Gen AI offering or AI offering at all. And so what those companies are all trying to figure out is, can we charge more for this, or is it just going to be part of our typical product? What is our cost going to be? Because your traditional cloud compute, or if you manage your own compute, costs weren't very high, which is how you had 85 or 90% gross margins. When you start having to pay for not only that cloud infrastructure, but also an LLM, there's a different cost structure. And so we're spending time with our private companies trying to help them understand that as well. And it just hasn't worked its way into the market yet. Combined with, if you look at what happened in software in 23, you saw consolidated spending. CFOs went to their teams and said, fewer vendors, spend less. If you just look at the data on NDR for public companies, it came down. So net dollar retention, which is one of the most important metrics in software. If you look at the rep data from RepView, which publishes sort of like what percent of sales reps are hitting quota, it went down last year. So every metric in software for public companies went down, and there were very few companies that exceeded expectations. You had companies like CrowdStrike that continued to really grow at a blistering pace. In the private market, Databricks is continuing to reportedly do very well. But look at how far Snowflake's come down. And so it's just, but the last 18 months in software have been challenging. And it reminds me a lot of if you were in Silicon Valley in kind of 06, 07, 08, pre-iPhone. It was that we were coming out of the doldrums of the dot-com crash. Everybody had sort of left Silicon Valley, and everybody was sort of like, what's next? What's going to be interesting that's going to light the world on fire? And literally in the next 3 years, we got the iPhone, we got cloud, we got Facebook, we got Square, we got Uber, we got Airbnb, we got all this unbelievable innovation that happened in that little, all those companies got started between call it '06 and '12. And so it feels like we're right on the precipice of that moment, but it's just going to take a little bit of time. It's going to take some time to work itself out. And then I just think back to the point earlier, the Mag 7 just has been dominating the conversation so much in a public investor world that they just haven't had any appetite to go buy. Why would I, if I can put another $500 million in Google, why would I want to put $50 million in the IPO of an unproven company that hasn't shown me they can beat quarters? That's really the fundamental issue we have with the IPO market right now.
Yeah, and what's interesting though, I mean, to your point, we just read off how far they are from their recent highs, and now that sort of relative underperformance to the major indices, it kind of lets you believe that folks are kind of scaling out of the trade a little bit. They're moving, and you know what the best performing sector in the S&P this year is, Jeff? Just take a guess right now.
Financials.
Utilities. Okay.
Utilities.
So it's utilities and then staples. Okay. Financials are doing just fine also. But what does that tell you about, like you just said it, the kind of fear that the jitters that a lot of investors have? So I think the idea of just plowing money into the perceived early winners of generative AI, that's kind of come and gone. And now that we're getting to a stage where we're starting to see forward estimates come down a little bit. And I just want to hit one other thing. I heard one of the dumbest questions I've ever heard on financial TV, and I'm not going to say who asked it and who answered it, but they were talking about some of the same conversation that you and I were having. And the guy said, well, if you go back 25 years and you look at the internet, and you look at how successful these companies have been. And then, the answer was, and I'm sitting there voicing it to myself as I'm watching it. Yeah, but the NASDAQ went down 85% from its highs in March of 2000 to its lows in March of 2002. And, and obviously, yeah, there were a handful of stocks that also lost 80% of their value, or maybe some 90% of their value. Now they're trillion-dollar companies, but there's hundreds that went out of business. You know what I mean? And so I just find that kind of whole notion really interesting. The last point I'll make about that is when folks don't think that stocks, you know what I mean, because there's a floor in it, because of their positioning or their market share or the advance that they have in whatever technology, from the highs in 2021 to the lows in, October of 2022, Facebook, which is Meta, obviously, Tesla, Netflix, NVIDIA, they lost 70% of their value. Now, people were just as geeked up as they were about metaverse than this. And if you think about the revenues that these companies are recognizing, it's not that much more right now. You know what I mean? So, so talk to me a little bit about the idea that no one thinks that this can go down in this trough of disillusionment phase. I mean, but I know no one wants it to happen. Like that's the more important thing.
Well, and let's not forget the most valuable company in the dot-com bubble was Cisco, right? Which was selling the hardware infrastructure to power the evolution of the internet. So some parallels to what we're seeing today.
Well, hey, but by the way, and one of the other largest was Sun Microsystems, which was making the servers that power, I mean, like we can look at, by the way, if you look at NVIDIA's, GPUs, okay, they go into the servers that Dell and Supermicro make. And then also memory from Micron goes in there, right? I mean, the list goes, like we can do this. Micron has round tripped its whole like little journey over the last year and a half. Dell has done the same thing. Supermicro has done the same thing. And if AMD were ever to come up with a competitive product to NVIDIA, then you're going to see margin compression massively, right? And so, like, to me, I just think there's a lot of stuff going on here. You could look at the guys that design the chips. You could look at the fabs, you know what I mean? Like Taiwan Semi has 90% of the high-end GPU, manufacturing business. So there's a lot of concentration. And you also mentioned that those four companies, Meta, Amazon, Google, and Microsoft, they make up 40% of NVIDIA's revenues, and they're all actively trying to design their own chips because they want a second source.
And there are private companies. The good news is there's so much capital flowing into this space that we now have private companies that are trying to go after some of this market as well. So they're early. There's a company called Cerebras. There's a company called Grok. There are several others. There's one that a friend of mine just funded that's started by a couple of folks in their 20s who are off the charts smart. But there's the market, if you go back 10 years ago, nobody wanted to fund those companies because it was sort of like, gosh, where's the innovation? Where's the opportunity? Where's the window in the market? Where's the tailwind that you could catch? And so I think one great thing about Silicon Valley is the market never stays still. And as long as there's demand and there's an opportunity and a TAM that's growing in front of us, people will fund entrepreneurs with great ideas. And I will say, one of the things that we have an advantage of as venture capitalists is each of us meets hundreds of companies per year, and our firm will meet thousands. We are seeing so much cool stuff. We haven't even talked about, like, think about what's going to happen with Hollywood with AI. Think about what's going to happen with people being able to design and do image creation and all the fun things that people are going to do on their phone. We think of all the weird things that people are going to do, but think of all the fun things that they're going to do. And one of the partners at Andreessen Horowitz always tells a great story about how, if you remember in the late 90s, there was literally a website you could go to and there was just a big red button. Or remember when the iPhone came out and one of the first features was a flashlight? And everybody's like, oh my God, there's a flashlight on my phone. We're in that phase with Gen AI right now. And as it works itself out and these founders are able to do their thing, raise capital and go build cool products, I just think you're going to see a lot of really cool stuff come out over the next year. It won't have a meaningful impact on those small and mid cap companies in terms of revenue forecasts, I don't think. You've seen a few companies kind of making noises and saber rattling, saying, hey, we're starting to see real revenue here. You're seeing folks like McKinsey and Accenture come out and say that they're doing hundreds of millions of dollars in advisory work around Gen AI, which I sometimes find a little hard to believe. But I do think that, it is going to be transformational. And we're already seeing for our 10, 15, 20 million ARR businesses that are selling AI into, for example, the financial space. I've got a company called Vic.ai that helps people do invoice processing and bill payment. Not super sexy, not going to ever end up on stage at Apple, but is delivering meaningful ROI for customers. And as that company grows, you're going to hear about that as a very obvious area where AI can play a major role. Procurement, sourcing, sales, marketing, all these functions that are not super sexy and aren't going to be, shown up on stage with Tim Cook. There are a ton of entrepreneurs working on stuff in that space, and it is going to be meaningful and it's going to generate real revenue. It just hasn't shown up yet. And it probably won't for 24, 36 months.
Yeah. And listen, I'm sure that reminds you a lot of SaaS models 10 years ago. You know what I mean? It was doing a lot of the same stuff. And again, that all makes sense to me. Demonstrate the use cases, demonstrate the ROI, right? And I think you're going to have a bit of a market. And that's probably when you start seeing some M&A too, right? Because you're going to want to package a lot of those different services together. I want to read you something, and this is from the information. I think it was last week. And I think this is really important because I think in the near term, it highlights some of the risks, but in the longer term, it really highlights what a massive opportunity this is. So the article was, Microsoft customers pause on Office AI Assistant due to budgets and bugs. Okay, for many Microsoft business customers, the company's AI assistant for Excel, PowerPoint, and other applications that hasn't delivered enough benefits to justify the expense of the software. It goes on to say, only a small portion of Microsoft's business customers have adopted Copilot between, you ready for this, 0.1% and 1% of the 440 million existing users of Microsoft 365 are also paying for the new AI features. This translates to between 400,000 and 4 million paid seats for the Copilot product. So that's fascinating to me, right? So in the near term, you could make the argument, well, no one wants this crap and they're not going to pay up for it right now, right? Until it hits. But then on the flip side of that, they're going to get a lot of this stuff right. And then it's going to be this massive upsell opportunity.
Yeah, we're on version 1. I mean, it's kind of like, if you remember when the iPhone first came out, it wasn't a default assumption that every software company needed to have a mobile version of their software. It was sort of like, oh no, people will still go to the internet, they'll log in, they'll use their PC or their Mac. And then it became kind of understood over time that you had to have a mobile version of your software as well. I think that'll happen here. And then I think, look, one of the flaws in the way that the current version of Gen AI works is this the technology wants to give you an answer. Right? It can't say, I don't know. And so it will give you an answer. And in some cases, it hallucinates and gives you, funny answers. You see a lot of that on Twitter with people showing things. It's just going to take time to work itself out. But one of the challenges we have right now is that you can assume that the models that are out there today from OpenAI and others have consumed pretty much all of the data that is available. And so now we're getting to this question of, well, what do we do next? Do we use synthetic data? What do we use to keep these things going and improving at a rate that's interesting for customers? Another part of the equation that a lot of people don't think about, I was talking to the CTO of a Fortune 1000 company, and he said, look, one of my problems is the version of Gen AI that I had a year ago was fine, but they keep asking me to upgrade. We're just not built to deploy technology that way. We don't, we bought SAP 15 years ago. We're still running like that version of SAP. So the models have been changing so quickly that for some enterprise customers, they're just not ready to take advantage of them yet. And that cycle is just going to take time to play out.
Well, it's funny. So we talked about regulatory, and the OG was Microsoft 25 years ago. If you think about, right, that like what was the problem there? They were just kind of jamming Microsoft Explorer or Internet Explorer onto their operating system. And it was very anti-competitive. Well, think about this. If Microsoft starts giving away Copilot, right? Embedding with those, we just read the numbers there. They have, 440 million existing business customers. Like, think about that globally. It runs the risk of being very anti-competitive, right? And so when I think about like the regulatory environment, it's not going to slow down. One of the huge beneficiaries, I would guess, not just because of Google Cloud, but also because of Gemini. I mean, Google has what, 5, 6, 7 properties that have over 1 billion users. A few have like 2 billion plus users. If they can ever get Gemini right, I'm not so sure Apple Intelligence is going to be that important because, yeah, on-device stuff is going to be really helpful, but it's a couple years away. In the meantime, if I use Gmail, if I use YouTube, if I use all these other, G Suite, all these other Google applications on whatever device I use, well, Gemini is going to be coursing through that, right? And so it's going to do a lot of the things that Tim Cook and team laid out today on this Glow Time. And so I guess I'm curious, like, to me, just like Microsoft, I think there's a huge opportunity. I think there are regulatory headwinds, and I just think we're just scratching the surface on that. The DOJ is looking at some of the behavior by NVIDIA and the way that they're kind of locking customers in with CUDA and their software. You know what I mean? So I think that's going to be a huge thing. But I think Gemini right now is being totally underappreciated. And I really do think it has the ability to be a bit of a dark horse. Thoughts on that, and thoughts of how you're using it as a consumer? Because I think the consumer stuff is years away. I think the enterprise stuff is going to be the thing that's easily monetizable in the near future.
Well, a lot of folks are long Google. I talked to several hedge fund managers who are long Google with the thesis that a breakup is coming. They'd love to see GCP broken out from the mothership. And potentially, famously in the show Silicon Valley, you've got the folks working up on the roof drinking the big gulps. And I think there is still some of that at Google. And so if you split it up and had Android and YouTube and the infrastructure business as separate businesses, you potentially unlock a lot of value. Obviously, a lot of folks have had that same idea with Amazon. So it'll be interesting to see how that plays out over the next year. I mean, obviously, the big issue with antitrust has just been all of this has been relatively good for consumers, right? Costs have come down. So, go back to like the mid 2000s when you had to have like a Nokia phone, texting on AT&T, downloading an image for some crappy third-party service. Like none of it worked together. Apple and Google have a hammerlock on that market, but it's been great for consumers. And so to me, that's the biggest sort of bipartisan issue the FTC is going to have to figure out over the next few years. And then just from an anti-competition standpoint, it's really hard for any small company to get traction within those app store environments. And I'll give you one example. We were an investor in a company called Tile that basically invented the category of finding and tracking things you love, your keys, your pets, et cetera. And at one point, Apple just said, oh, yeah, well, that's a great idea. We're going to launch our own version. They launched AirTags, and it's a multi-billion-dollar business. So that is a challenging part of the tech ecosystem that I'm not sure how we're going to sort out anytime soon. Probably is going to require a lot of understanding of if the traditional model question for antitrust was, is it bad for consumers? There's going to have to be some new flavor of that that's going to enable more competition for smaller companies. But I do agree with your point about enterprise on Gen AI. I mean, I think that the efficiency that a company can gain. I mean, if you look at what Facebook's doing with headcount, how much they're growing, not Facebook, Meta, how much they're growing the business today without increasing headcount, that is happening because of technology, right? People aren't, they're using copilots for coding. They're using technology in their sales and marketing and finance functions. They've got a mandate internally to be more efficient. So if the world gets more efficient, companies do get the ROI out of this technology. I think it's going to be great for S&P. It's going to be great for, QQQ. It's just going to take time to play out, right? Companies, even if they implement all this technology in the next 12 to 18 months, are they going to do the same thing that Mark Zuckerberg or Elon Musk did and lay off half their people? Probably not. So that's going to take time to play out. And then I think the other category that I love is the small business economy in the US. It's 42% of US GDP. It's 55% of our workforce. I think AI is going to be a huge tailwind for small businesses, because if you think about the way a small business operates today, there's a business owner who's got 5 to 10 people that work in the shop. The business owner does sales, marketing, finance, bill pay, HR, payroll. When AI can come in, or AI, Copilot, Gen AI, whatever version of AI you want, can come in and do a lot of that work and take that off the business owner's hands, I think it's going to make those small business owners that much more effective and that much more profitable, which hopefully means they can then open more shops and hire more people, and small businesses become an even more important part of our economy. So nobody talks about it. It's not sexy, but I do think SMBs will have a huge tailwind from AI over the next 5 to 10 years.
Yeah, and they're just generally slow to adopt that technology is the one thing, right? So we can kind of push out some of the expectations, because for them to kind of buy that piece of software that it doesn't actually, it's not, take it to the bank, it's going to be that sort of thing. It just takes a while to see other situations that are being successful at. I guess that's just my 2 cents. I want to talk about Meta because I deliberately left it out of that conversation with the hyperscalers. And for all the reasons that you just mentioned, I think it's also because the hype of metaverse, the company changed their name. Remember, Mark Zuckerberg showed up in this like metaversey thing and gave this presentation, okay, like of how this was going to change the whole company. And then the stock, literally, he could have rung the bell. That was it. The stock lost 70% of its value over the next 18 months or so. But the interesting thing was that they deployed a lot of that technology, a lot of that build, a lot of that know-how. And then they went through, and you and I were talking about this in 2022, then they went through that period of rationalization. Well, and think about this. Why is that stock only a few percent from its recent all-time highs and up 50% or something on the year? Because they've gotten a bunch of those benefits out. They've gotten a lot of leverage. It's one of the reasons why it is the cheapest stock in the Mag 7, And so it's ironic in a way also, as Elon has become this sort of villain, at least in certain circles, if you will.
For a lot of other reasons.
Well, for a whole host of other reasons. But Mark Zuckerberg, who is the evil, he's the villain in 16, 17, dragged in front of Congress all the time, sweating like a, he's now this guy, he looks like a genius, and so it's just interesting how those narratives.
He's got a remarkable job, and championing open source in this space, I think, is smart. You look at the properties that they own with Instagram, Facebook. I think they're really well positioned, and I think I don't know if you read the white paper that he put out, or the letter that he put out on the importance of open source in this space. I think was really well said. And to your point, the rebranding of him as the sort of kickboxing champion, man of the people, has been quite remarkable. But I do think, look, Facebook's always had a history of being an early and aggressive adopter of new technologies. And I think that he's reignited that, sort of gotten the whole company reignited around being an early adopter of this technology. And he said, you've seen interviews where he said, look, metaverse may or may not happen. But to your point, we took a lot of that know-how and a lot of that learning and repositioned it to be in this space. And we have no choice. We have to go after this space, because everybody knows that we're going to dogfight with Amazon and Google and Microsoft and Apple. So I actually own it personally. I think Meta is very well positioned. I think they have a dominant position with a huge user base. And you look at the power of a platform like Instagram. I think it's very similar to the way that YouTube is for Google. And you just look at how much people don't even talk about things like YouTube TV. What an amazing property that is for Google. So these companies are massive, and when they apply their resources to these products, they create great products. I think they'll do. That's why so many people want to own them. When you talk to any major, to your point earlier, talk to any major hedge fund, they all own all these names.
Yeah. Well, the other thing I'd just say is we talked about Apple is probably going to be the first, beneficiary from a consumer standpoint of Gen AI. I mean, Meta has yet to kind of turn on that monetization yet. If you go into, Instagram, it has 2 billion monthly actives around the place. They have Meta AI in there. I don't know anyone who's using it yet. You know what I'm saying? No,
It'll
it
happen.
will. And
Yeah,
my point is like, those things are training on your behavior right now. Like
exactly.
every time you're making a click on it and that sort of thing. So I agree with you. I think that one, but this is kind of my point in a way about Microsoft and about Google. If you're an investor and you're not loaded up here, you want to see those things go down 30, 35, maybe 40%. You want the sentiment to get really bad because, you want to basically round trip a lot of the move from early 2023 to that. That's when you will see people just puking it out. And that's where the opportunity is for them to go again and double. You know what I'm saying? Because then they're going to turn on the monetization. They're going to be that much forward or further along in this whole journey. Does that make some sense to you?
I think it makes 100%. I think that the X factor on that increase in revenue coming from these new products around Gen AI is what can they charge for them? So you made the point around like Instagram with Meta. If that becomes an embedded experience in Instagram where they're leveraging AI to do a better job of targeting and enabling you to buy products, it becomes a very important e-commerce platform, which it already is. Is that going to drive it? There's not a super discernible what is the increased monetization there, other than people are going to sell more products and more clicks on Instagram. And so I think we're still in the early days of like, what is the true monetizable piece of this? And I know that there's going to be a bunch of added cost, right? Because unless I'm building my own, and this is where I think Meta has a huge advantage, unless I'm building my own, if I'm relying on other folks, LLMs, other models, other infrastructure, I've got this cost that's not going down that quickly. I mean, the cost of the tokens is going down, but the actual dollars that I have to spend on GPUs and whatnot is still going up. And so we're just in this like it all feeds into that trough of disillusionment in 2025, and that's when your buying opportunities. Maybe that's when we all jump in.
Yeah, you just made a point earlier about talking to, I guess it was a CFO or a CTO of a company that, buys a lot of software, deploys it, and they just can't keep upgrading. It's kind of going to turn into the same thing when I think about GPUs in a way. So there's been just such demand and such limited supply of this Hopper chip, right? So this is, the GPU made by NVIDIA, and people were double, tripling orders. That doesn't even, speak to what was going on with the Chinese over the last year and a half trying to get access to these sorts of things. And now all of a sudden, you probably way overpaid just to get them, right? And you built out, this compute,
And then
and
they're
now you're
obsolete
being
18 months later.
yeah, and now you're
Yeah.
being told
Yeah.
you have to upgrade to Blackwell, and then Blackwell's delayed, and now you have to buy more hoppers to keep up with, the competition. And then what's coming along? Rubin's coming along, in 2 years, that sort of thing. So at some point, I think that probably slows down a great deal. I think a lot of these hyperscalers are going to probably, you made this point earlier, they are going to overbuild capacity, right? And that's when pricing starts to come down and margins. So like, I think when it comes undone, and I don't mean undone like it's over, it's not like going to be the metaverse or whatever. Is going to at least be in valuations, and it is going to be the way that investors are thinking about these from a portfolio standpoint. That's just my 2 cents, and I think that's what comes in the next few months. I think it goes from an aggressive buying of dips, is what we saw over the last 18 months, to possibly aggressive selling rips to some degree. Because again, what comes next is a softening of forward estimates and probably a valuation check.
Well, and just given how important NVIDIA and some of those other components are to the overall S&P 500, if they go down, everything's going down, right? Just like they've taken it all up over the last 24 months. So that would be your cue that maybe you're starting to get value in the market and you're being able to buy based on what you think is coming in 26, 27. The only thing that I would say could be a counterbalance to that is if you think about where we are today, that's wildly different than where we were in phase one of the internet, call it 99, 2000, 2001, and even, when cloud and mobile took off in 08 to 010. Today, you've got billions of people who are very comfortable with what I would call microtransactions. They've got a credit card in multiple places on the internet, and they have no fear of spending $1 or $3 or $5 or $10 a month on something that's a new product that they're going to try. That wasn't happening 15 years ago. And so the one counterbalance to the trough of disillusion, revenue is going to take a long time to play out. The counterbalance to that would be, imagine if there is something really compelling, and we've seen this with ChatGPT. If there's something that's really compelling that comes along from Apple or Meta or a startup that people, it's a must have item, it'll take off quickly, and it'll blow people away at how fast the revenue growth is. And we just haven't seen that yet. And I'm hopeful that what we'll see it in is categories like health and wellness, maybe in education, helping people get further along faster, learning languages, things like that. So there's a bunch of new stuff that's coming that we just haven't seen yet. And the entrepreneurs haven't even had a chance to get these companies off the ground yet, but they're coming.
What I'm just curious, what are you using? What interface are you using? ChatGPT? Are you using a wrapper like Perplexity? Are you using
I
Claude?
like
Like
both.
what
Yeah,
yeah.
I like Perplexity. I like ChatGPT. Obviously, I use Google quite a bit.
Yeah.
Um,
Are
you
you
know,
paying what are you paying for though? To me, like, so for instance, I paid for GPT because it was the only thing at the time, right? And then when Perplexity came out, well, I had the ability to choose GPT or choose Claude, and I'm sure like Llama, will be in there sooner or later. So my question is, why would anybody use anything other than a wrapper like a Perplexity when you could choose between all of those and pay $20 a month? And then the other one, I think the reason why you might pay for Gemini, and Gemini is not yet in Perplexity, is if you're a power Google user among all these properties that we just talked about, having that flow through, and even the productivity suite and that sort of thing. That seems like a no brainer to me.
well, the ultimate, and this is going to go back to your point earlier about antitrust. The ultimate value of this technology is when it really gets to know you. And so, to your point, if I am a power Google user, I want the AI to know me, to know when my meetings are, to know how to prioritize my emails, to know how to prioritize my notifications. That was one of the things that, from what I saw today, Apple demoed was prioritize notifications using AI. So you want that. But at the same time, the only way you're going to get that is if that technology is embedded across a whole bunch of products, which sort of cuts across, you go back to your point about Microsoft back in the late 90s, trying to embed the browser in with the rest of the software. So there's going to be this really interesting tension between I want this personalized knowledge, I want the AI to know who I am, but at a regulatory level, they're going to say, well, gosh, we have to have competition. And I think that's going to be a little bit of tension, but that's clearly where Apple wants to go. It's clearly where Meta wants to go. I think it's going to be great for us as consumers, but there is going to be a lot of conversation around privacy and competition.
Yeah, no doubt about it. All right, Jeff Richards, I could do this all day long with you. I mean, we'd be like the most boring guys at a bar. You know what I mean? If we'd get through the football stuff really quickly,
Right.
and then we move to this nerdy stuff. But I
By the
really
way, we didn't
appreciate
even get to my favorite pick from 2 years ago was my
Blackstone.
my 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 basket with billionaires, Blackstone, KKR, TPG, Blue Owl. Those names have been amazing. And
Well, let's hear that because there's actually been some dispersion in some of them. Like, for instance, Blackstone acts a lot better than, let's say, Carlyle, and Apollo's kind of right there in the middle. And so it's interesting. They all got hit really hard in early August. And again, there's uncertainty about rates. There's uncertainty about deals. There's obviously private credit is like on the tip of everyone's tongue in a way. So talk to me a little bit about it. I'm definitely really curious because again, I thought that was those were one of your early picks 3 years ago when you came
yeah,
on the pod. We meant to
yeah,
talk tech, and
and
you
they've
got
done
right to
well.
that. Yeah. Well,
My,
they
my
they they look like some of the Gen AI guys.
Yeah. So my general theory has been for some time now that more and more capital wants to be in the private markets, right? And we have half as many public companies today as we did 30 years ago. There's by definition, there's way more private companies than there are public. And so what you've got is all these asset allocators and family offices around the world trying to find places to allocate. Everybody owns the Mag 7, QQQ, SPY. Where else am I going to go to look for differentiated assets that I can buy that aren't necessarily correlated with those? And so one, you have this trend towards capital seeking out the private market. Two, when SCB collapsed, you basically had a massive lid put on local lending, right? The small business economy in the US traditionally has relied on a small regional bank to lend you capital to build your business. That market, one, rates went up, and two, we have a much tighter regulatory environment today than we did 10, 15 years ago. These folks, these alternate capital providers have stepped in with private credit, and that's become a huge, and I put it on Twitter a few times. I mean, the chart, you look at how much money has gone into that space over the last decade. It's incredible. TBD how the default rates work out over time. And then the third one, for me was just when you look at a higher interest rate environment, what you're generally going to have is less liquidity, less exits. Buy them when they're in that mode. And when rates come down and they do have liquidity and exits, their distributions to LPs and to their shareholders go up. So I love these names. I own all the ones you mentioned. I own Blackstone, I own Blue Owl, I own TPG, I own KKR. The theory is I'm getting good growth in that flow of capital into the asset class. I'm also getting paid a dividend. And the former partners of these firms all get paid a lot of money in dividends, and they like those dividends. So they're good.
Yeah.
It's good to be a partner with billionaires.
Jeff Richards, I really appreciate you being with me. I hope you'll come back really soon. I really enjoyed the conversation.
Good to see you and great to catch up.